Now, Capitec reported a 35% rise in its first half headline earnings per share to 702 cents. The group's return on equity rose by 28%, while its active client base grew to 4.2 million. The mass market lender also aims to raise $275 million through a rights issue to boost lending and fund growth in its branch network. Capitec closed down 1 1/3% to 206 Rand, pretty much in line with the general market today. For more, the company CEO Riaan Stassen joins us on the desk. Riaan, thanks very much for your time. Well, the market's got very excited about comments from your side saying that you're going to be looking at international expansion, although you have said that's only 12 months out. How real are these expansion plans?
Well, we've always said we're going to focus sharply in the business that we conduct, and if we grow to a certain level in South Africa, we'd want to internationalize the model. I believe within the 12-month period, we will have to start looking seriously at the internationalization. So that's really on the agenda currently. But there's no firm commitment, no firm plan to do so.
And the rights issue is to obviously grow your loan book and also to fund growth in South Africa. Another 50 to 75 branches in country, is that correct?
That's correct. We stated that we plan to open 50 to 75 new branches per year for the next 3 years.
How do you feel about the Capitec story? You can't sneeze at those numbers that came out again. Solid growth.
I think a strong set of numbers. I mean, your stock, whilst down on the day, certainly doing a lot better than some of the other stocks we saw. A lot of concern, obviously, around bubble coming through, as Annabelle mentioned, in the unsecured space. So perhaps your views on that, and just in terms of sustainability of this growth story. I mean, we've seen that growth in the share price start to taper off. We're off the highs right now. Looks as though it might start curling lower. The market's going to be expecting a lot from you guys. You're looking extended on a PE multiple basis relative to some other peers that don't have that growth priced in.
But not relative to the industrial sector. He's a perma bear.
Where to from here, and how are you going to deliver that consistent growth that we've gotten used to over the last 4 or 5 years?
Well, the first part of the growth story will be in a continued increase in our customer numbers. We haven't seen a decline in that growth over the last 6 months or even the last year. Frankly, it's been on an increasing trend. We believe that the market find our offer very attractive from a simplicity point of view and from a value point of view. We're doing a lot to re-engineer our operations to really be highly efficient in dealing with the customer's expectation. So that's on the service side. We believe that we can still grow our customer numbers significantly, but a good growth area for us is in our transaction fee income. That grew by 61% for the 6 months, really as a result of 3 things. One, growth in customer numbers. B, growth in change in the mix of our customer base, more towards middle income market that make use of our banking facilities to a greater degree than your lower income market. And then a change in behavior in our traditional customer base as we roll out more functionality using virtual channels like cell and internet banking.
And of those factors, which would you say is the key driving factor? What's driving the majority of the growth that we've seen in this set of numbers?
It's basically utilization of our full offer, and not typically your lower income market. If they bank with you, they convert salary to cash as soon as possible, so that you don't generate debit order income, you don't generate income when they use their card at point of sale.
So
for the
moving
other services.
moving up the value chain.
Moving up the value chain.
Okay. I mean, on that basis, I mean, you've seen the sort of the big 4 banks sort of attacking this segment of the market quite aggressively as they also try, get a bite of what has been a very, very juicy apple for a while. I mean, from our point of view, the concern, I look at Abel's numbers and yours, is that the vintages or the terms of these loans seem to be blowing out slightly. Is that because you're targeting increasing term to maturity, or is it because you're starting to see a distressed customer come into the base?
Well, that is, why I disagree with the view that there's a credit bubble looming in the unsecured lending market. If the market gets overheated, it won't fall over overnight. Obviously, if we have large-scale industrial action and the whole economy comes to a standstill, that will be a catastrophe. But you won't find, I've never seen that in unsecured lending space, both on credit cards and so forth. You get an overheat and then a correction. That happens over time. What is different in South Africa, though, is that we have had a structural change in the credit dispensation combined
The National Credit Act, or
with the National Credit Act coming into being in 2007, with quite an important factor is the transformation of the country. And that has had a huge impact on the way most South Africans structure their balance sheet. Now, the correction of that will be a lengthening of loan tenures over time and an increase in lending amounts. And what the industry players have done since 2007 to do so on a gradual basis. So it is not to consolidate debt on distressed customers and so forth. And what I don't understand, the NCR statistics don't support any indication currently that the market is in distress. Frankly, for the last quarter to March, the arrears numbers was at its best levels over the last 3 years. Also, the impaired numbers was at good levels. If I look at Capitec's book, we've experienced exactly the same situation.
What would the flags be that you look for to say that there is trouble afoot? Because obviously you haven't seen them yet, and this is your territory.
What we would be very cautious of, and what we track quite well, is what happened with a customer that's taken a loan from us afterwards. So do they increase their exposure by taking credit from other credit providers or not? And we haven't seen that to any scale. So what we monitor very carefully is the disposable income levels of our customers. And bear in mind, as part of our credit assessment model, we track that. What I am quite comfortable of is that if you look at the industry players today versus prior to 2007, you sit with pretty responsible, sizable organizations like African Bank, Nedbank, Standard Bank, and so forth, that use fairly sophisticated models to assess credit. Also, if you look at the income base, and this is probably overlooked by most people that don't analyze the growth in unsecured lending carefully. Stats SA will tell you that the salary bill of government from March 2008 to March 2012 increased by 71%. That the average salary of civil servants have increased from 10,000 Rand to 15,000 Rand. If you look at the NCR statistics again, there's a marked increase in unsecured loans to the above 15,000 income category. That has moved up from 17% to 38%. So these things all gel. And the reason for that, as far as I'm concerned, is the structural change that is required for South Africa going forward. Because you must bear in mind that the majority of South Africans funded long-term assets, either with short-term money or savings. And
Riaan,
that need to be corrected going forward.
I mean, that structural shift you've mentioned, that's quite key in terms of your story and why you believe it's just quite sustainable. Just on the competitive front, I mean, when you're looking at that credit extension, you said you look at a customer, do they expand their exposure to credit once they take a loan from you? Does that take into account the unsecured lending that's effectively happening through a lot of your retail chains that are out there and some of the stuff that we're not necessarily seeing through your conventional players and your banks in that system? And how do you see that as a risk factor to your industry?
Now, sure, we look at total debt exposure. Bear in mind that the retailers, furniture retailers and clothing retailers have been in the forefront of providing credit in South Africa. We've got very good credit records of the total customer base in South Africa, to which we've got real-time access, and we model all that information into our systems. Frankly, we know that if a customer has taken a loan from Capitec and afterwards take another loan, that your probability of default will be higher, and our provisioning models make provision for that, take that into account. I fail to see that the fairly significant growth that we've had to date will lead to an explosion
What about a change in the interest rate cycle? I remember asking you this question the last time we were on the show together.
And this is what you were discussing with Annabelle. What is going to happen when interest rates change?
Even though most of the consensus view out there is for flatter rates for longer, that's going to change at some point in time. What does that mean for your book and for your client base?
Well, two elements there that's important. We only do fixed term lending. So with regards to our customer base, their position would be unchanged in an interest rate increasing cycle. Obviously for new loans, that will be taken into account when you assess their affordability with regards to the increase.
The credit checks, etc., before
correct.
you sign them on.
What is important, we follow a very conservative liquidity management approach. So we match the tenure of our loans with the tenure of our funding, and we fixed interest rates as well. So we don't run an interest rate risk if the interest rate on our lending book remains flat, but the interest on deposits increases.
If you look back at the last cycle, let's say in 2003 when rates came off, we had almost 5 million people get sucked into that credit cycle. This time around we've had less than 1 million. You could say the industry looks like it's almost kind of going X growth. It's moved through that exponential growth phase. Why the rights issue? I mean, is it just a timing by the Buddha Buffett, Mr. Maton? Is it from yourself? Do you see like a lot of requirements of capital in Africa, or?
No, we require additional capital to fund the existing growth in our book as well as in our distribution network. The timing of the rights issue is earlier than what we planned for. We actually planned to do capital raising in May next year, and that was really driven by our approach that it's better to raise capital when you can than when you're forced to, because times are tough. Times in the capital markets are tough, so we don't want to be in a position when we have to raise capital come May, June next year, and there's a catastrophe somewhere in the world that we're not in a position to do so. So we thought it was opportune now to raise it, and we got the rights issue.
I'm going to sneak in one more question because they're saying to me, wrap. Just very quickly, in terms of Africa and your opportunity there, it doesn't look as though that is an exciting territory for you. That's how you've been quoted today. Is that a fair assessment?
That's a fair assessment. When we internationalize, we would want to do so in countries with high potential. The challenge in Africa is in the infrastructure. We largely dependent on fixed line communication. We run a real-time business, and in that regard, Africa is difficult.
I'm being confused by the director there. Do we have more time? Are we out of time? We've got more time. There we go, gentlemen. See, Riaan, we're keeping you in here for longer than anticipated.
Can I ask a quick question?
Of course you can, yeah.
On this, I mean, your return on equity is spectacular. Do you think with this extra amount of cash you have on your balance sheet, will you be able to deploy it quick enough to keep your ROEs at these levels? Or do you think, like all the other banks, you're going to start with the increased liquidity requirements, start showing a bit of a...
Our objective was always to have a return on equity above 25%, and with the additional capital that we will be raising now, it will not decrease below 25%.
Just one question on the strikes that we're seeing at the moment, and you were saying that obviously if we do see the strikes bringing the country to a standstill, then we're facing a calamity. That's not your instinct here. You think we're going to see our way clear through this situation? Yeah,
I think it's part of a political cycle that we're going through. I'm no doubt concerned about it. I said when strikers got a 22% salary increase, that's a good reason for people to strike. So we are concerned about it. We manage it fairly carefully. I think one of the advantages that we do have, we risk weight our employers on both industry and employer basis. And when we foresee risk, we manage our book shorter. So that it's interesting times is a fact. To what extent this will materialize to nasty times, I hope not.